I invest like a bank, and here's how you can, too. Before you start investing in cash flowing assets, you'll want to start by cleaning up your own personal cash flow. You have two goals for this phase. First, figure out where your largest expenses are and make significant cuts to the areas that don't bring you joy. Second, get rid of any high interest rate debt that you may have while keeping any low interest rate debt, including taking on more low rate debt if you're comfortable. Let's break that down, starting with the first one. Three main areas of potential excess spending on most people's budgets are housing, transportation, and bars. You're looking for areas where you can cut hundreds or even thousands of dollars per month in ways that don't affect your happiness, not how you can trim $10 here and there. So I won't tell you to cut your lattes if that's what brings you joy, because for most people, coffee shops are a small item on their budget. First, let's talk housing. Personally, I am not cutting back in this area. We could live in a smaller and more modest home, but living in a modern contemporary home makes us really happy. So that's not an area we chose to cut out. That's not true for you. Could you live in a smaller space or one that's a little more modest? Do you have any room to negotiate your rent with your landlord? If you're truly devoted to increasing your cash flow, then buying a duplex or triplex and living in one of the units, aka house hacking, is one of the best ways to reach escape velocity and build your cash flow portfolio. Next up, transportation. If you live in a city, how often do you take Uber? Are you able to replace any of that by getting more familiar with public transit? If you have a car, is it modest and economical? Or is it a status symbol? Or do you have two cars, but you and your family could get by just fine with only one and a little planning? If you're still commuting to an office, that might not be the best place to cut if you're trying to get ahead in your career and increase income, because unfortunately, most managers in the workplace still prioritize promotions to people that they see every day. If that doesn't apply to you, try to avoid the gas and the wear and tear on your car by working from your home office. And bonus points if you take the home office tax deduction and increase your tax refund cash flow. Finally, a favorite of mine, your bar budget. In my health and fitness journey, you'll often hear me talk about my relationship with alcohol and how my life was utterly improved by cutting it out. If you're someone who has alcohol regularly, I encourage you to revisit that relationship to experience both a physical and mental health upgrade. But regardless of the impact on health, if you're spending hundreds per month on bars, it's a great candidate for a huge budget reduction or total cut. To bring this all together, your goal should be able to reduce your core monthly expenses budget by as much as possible without radically affecting your happiness or your potential. After all, this number will become your target with cash flow investing, so you want to set it as low as possible. Whether you're single and frugal and able to get away with spending $3,000 per month, or whether you have a family and childcare expenses in a metropolitan area and need closer to $10 to $12K per month, your goal is to get your core lifestyle costs as low as possible. All right, let's switch gears and talk about debt. Let me go ahead and sum up Rich Dad, Poor Dad for you. Some debt is bad, some is good. Bad kind is anything with an interest rate north of 6 to 7%. You want to avoid debt that carries an interest rate anywhere close to your target investment returns. For me, I target a 10 to 15% rate of return on investment in terms of cash flow, so I want any debts that I carry to have an interest rate of no more than half of that at the absolute most. Take a look at your debts. Are you carrying a balance on your credit card? Chances are that the interest rate is north of 20% APR, and there's no easy way to cash flow at a higher yield than that. So go ahead and get rid of credit card debt first. Same with any other consumer debt with a high interest rate. On the flip side, do you have a mortgage with an interest rate of 3 to 4%? That's probably something to hold on to, because that money is cheap. My mortgage is an interest rate in the mid-threes, and you can bet we're not refinancing that at 7%. So in general, your goal should be to get capital at cheap rates so you can invest in higher yielding investments and pocket the difference after accounting for taxes. Some of you might have your own home and have significant equity in it. At the time of recording this video, home equity loan rates are too high to be a good deal, but you should check current HELOC rates to see where they are. If your car is fully paid off, you might also be able to do a cash out refinance on it and pull money out at a low rate. Anytime I can increase our cash on hand and it'll cost me an APR of no more than 4 to 5% to do it, I consider it. Now, a word of caution. It's a good idea to build up some experience with cash flow investing before you take on too much debt, even if it's at low interest rates. Don't want to get into a subpar deal and find out that you're on the hook to make debt payments but without the cash flow to cover those. Uncomfortable. But while I like to use good debt to my advantage, I'm careful to not get more leverage than I'm comfortable with. More on debt and leverage later, but don't be afraid to consult a financial planner if you have any doubts about what a safe amount of leverage is for your particular situation. So let's take a step back and recap what we've unpacked. First, how to look at your major life expenses and make big cuts that don't affect your happiness too much without touching your simple pleasures like that morning cappuccino. Next, how to prioritize what debt to pay off first before you do any investments, and what debt to keep or even seek more of based on the interest rate it carries. I like to think of this as investing like a bank. Banks raise cheap money and they lend it out at higher interest rates, and they try to run lean with their operating costs. Of course, there are good banks and there are bad banks. You don't want to be a Silicon Valley bank earning yields that are way too low to make up for the risk. Instead, I invite you to look at your financial situation like a responsible banker. Once you've cleaned up your monthly living expenses, your budget, and your high interest rate debt, it's time to take stock of how much cash you have available to invest in cash flowing assets. Now, the goal is to evaluate deals, screen out the 90% of deals out there that are stinkers in disguise, and invest in the good ones, the ones that bring us cash flow and help us build wealth.